Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. We're starting off with the Qs, which is basically the ETF that represents the tech sector. And as I say each and every week, I leave my lines on the chart from last week's report so you can see how accurate the forecast was. And we hit it again. We hit on all markets to the penny. And what's most amazing is that the news that came out this week drove the market lower. I guess you could call it a knee-jerk reaction to the Fed and the expectations of what's about to happen with our economy. And what happened is the markets moved exactly as I said they would from last week. And as I zoom in here, you can see that these are the lines from last week. And if you're brand new to the Market Guys Weekly Market Report, I would encourage you to go to YouTube and listen to last week's report first. It's kind of like a setup so you could see how it worked out and you'll learn how to read the signals. Now, last week I said we would most likely rally in the Qs early in the week and then sell off, with the end of the line right here being my target. Now, the end of the line is 233.25. And today, as I record this on June 12th, we hit that precisely. And the reason I put it at the end here is because that would have been the pullback to the 20-period moving average. And if you look at where the 20-period moving average is, that's a 233.61 right there as I magnify that for you. And so we hit that target precisely. And now, what does that mean for next week? Well, we have a long shadow under that candle after a down move. And while that is not defined as a hammer pattern, because a hammer pattern is 2 to 2.5 times the length of the body, so that shadow is not 2.5 times the length of the body. So it has a long shadow, and it looks as though the market bounced right off of that 20-period moving average. That's number one. Number two, we had a slightly lower volume day, which tells us that the sellers were not as motivated as they were yesterday as they reacted to the news. And that's a bullish sign. So that's good for next week. The other thing that I'm looking at right here is the gap. You see this right here? There is a gap where yesterday the markets gapped down on the news, and 80% of the time gaps fill. So my target for next week is going to be the gap fill point right there. So I think we're going to rally right up to that gap, and then we'll have to see whether or not we reverse, because the other half of the gap fill rules is that after the gap fills, there's an 80% chance that the market pulls back. But again, it's still too early to tell. We'll have to wait and see if that happens. But for next week, I think we're going to move up to fill that gap. Now take note of that, because if you're planning on taking a long position, I would still encourage you to keep stops in place below the low from today. So that's on any stock that you would look at. I would keep that stop below the low today, because if it doesn't go up or the markets don't rally, then we could see pretty heavy selling as stops get triggered. So it's a very technical market, but you have to be very protective and more or less use good risk management principles. Okay, now as we go along down here, you'll see that the stochastics is still heading lower, but the interesting thing here is the CCI. Notice how the CCI is starting to hinge. And what I mean by that is, all this week, or towards the end of this week, the CCI was heading lower, and then after yesterday and into today, we see this little cut, right? It starts to turn, and that's called a hinge. So I think next week the CCI is going to rally just like that, and that's going to create some new long opportunities. Again, once that gap fills, all bets are off. We take our profits, and then we'll reposition the other way. So that's the Qs. Now, if we look at the diamonds now, this is the ETF for the Dow Jones Industrial Average, you'll see that I said we would most likely move lower, with the end of that line being my target. Let me zoom in just a little bit more so you can see this. I mean, it's pretty amazing actually, because I've been trading for almost 40 years now, and I've been using charts for about 35 of those 40 years. I mean, I'm talking leaning on the charts for about 35 years, and I can't find a better tool that's more reliable. So here we are. I said we would pull back with the end of the line right there at 260 for the diamonds. And yesterday we hit that target. Today we're bouncing off that 20-period moving average just like the Qs. But in this case, this is a hammer pattern. You see how the long shadow under that candle is more than 2 times the length of the body right here. And we see much lower volume today. So that is bullish. Now, again, I think, like the Qs, I think the diamonds are going to rally up to hit that gap fill point right there. Now, notice how I drew this angle. You see this? And I repeated this last week, but the reason I draw angles like that is I basically eyeball what we saw in the last month or so. And you'll see that the angles in which the market rallies, even if I go here, I'll erase this after I draw it, but it's called the speed line. You're not connecting the lows, you're not connecting the highs, you're kind of just angling in the middle or the mean between these highs and lows. That is more or less parallel to what I just drew. So when I draw these angles, I'm usually referencing the past history to make sure that I'm duplicating that. And that's why these reports are so accurate, is because the markets move in waves. And there's a lot of money to be made here, folks. If you learn how to read charts and you follow along with us, I'll teach you. And this particular report was still keeping it free. For how long, I don't know, but I'm keeping this free as more or less an ambassador to technical analysis because I want people to learn how to do this and make money. This gives you a huge advantage over the professionals who are trading and using order flow to protect their positions. Most average investors do not even know candle charts exist. And so tell your friends, tell your family, tell them about how accurate these charts are and how accurate the forecasts are, and we'll get more people involved. So again, next week I think the markets are going to rally. You'll see down here the CCI is also hinging again like what we saw in the Qs. Now let's go to the Russell 2000. This is 2,000 stocks, but they are more or less the small cap stocks. And you'll see that again, we hit my target. Just like that. I said, remember last week, Friday was right here, right? I said Monday, Tuesday, Wednesday, Thursday, Friday, just like that. So I recorded last week, I said we would go lower. Now for some people who are following very closely, they're probably saying on Monday and Tuesday, oh, AJ was wrong. How many of you? Raise your hand. I can't see you, don't worry. But I bet you there were people saying, oh, he's wrong. And guess what? I wasn't wrong. And it wasn't me, actually. It was the charts, and the charts were not wrong. We were reading this market exactly correctly. We were talking about, down here, we were talking about the negative divergence in the stochastics and the CCI. And I do recall saying that the CCI, when you see a negative divergence, that is the most significant sell signal that you're going to find. And guess what? The charts were right. So we sold off the end of the line right there. We hit the target on Thursday. This, my friends, is called a bullish harami. No, it's not a hammer. There's no long shadows underneath, but this green body falls within the high and the low of this red body right here. This is a very long red candle, and that green candle falls within. That is as bullish as a bullish engulfing pattern. So again, look at the angles here. You see this angle? I'm going to draw a similar angle just like that. I'm going to say that the Russell 2000 is going to rally right back up to fill that gap. We know this forecast was correct, so I'm going to erase that. I'm going to erase all these lines as well. Again, cleaning up the chart so you can see clearly how this is going to work out. And this horizontal line that I drew last week was a roll reversal support. Now keep that in mind when I direct you to our website. We have videos that talk about roll reversal, talk about gaps, talk about the indicators. So when we are at a roll reversal support level, that looks like it's going to hold. The CCI down here is hinging right there. I think the CCI is going to continue higher. Going to erase this again to clean the chart up for you. I like to keep it clean so that you can reference the lines that I drew next week. Okay, so there's my forecast for the Russell 2000. Now let's go to the VIX. This is an oscillating index that more or less leads the market. The volatility index is more or less the fear index. And usually the volatility index rallies when the market is selling off. Now look what happened here on the VIX, and then I'm going to hop to the S&P because the volatility index is inversely related to the S&P. So whatever I'm drawing here as a forecast line for the VIX, remember it's going to be opposite for the S&P 500. Last week I said that the VIX would most likely rally and move up to the 20-period moving average. This horizontal line was the 20-period moving average. And guess what? On Wednesday, look at that. The high was at the 20-period moving average. Then the volatility index rallied because the fear came into the market on that reaction and that the economy could continue to suffer. And you see what happened. Now this candle is an inverted hammer. That is bearish for the VIX, but bullish for the S&P. See this long shadow above that candle. And there's a gap below the market. I'm going to leave this line in place because that is now our new target level for the VIX. In fact, I'm going to erase all lines and redraw them because it's easier for me to do that. If I just erase the lines, I'm going to draw this horizontally just like that. That is a gap fill point. And I think the VIX is going to pull back to that. Again, look what I did. I took the angle from back here and I ran it parallel, pretty close to parallel right here. You see that? So I think the VIX is going to pull back. I think the general markets all across the board are going to rally. And then what we have to do is we have to watch out when this gap fills. Because if that gap fills, there's an 8% chance that it will. There's another 80% chance that it will reverse and start to go up, which is what? That's bearish for the markets, right? If the VIX pulls back and then bounces right in this area, if the VIX starts going up, the S&P is most likely going to drop. Notice the stochastics is hinging, and we have a definite pivot point here in the CCI. So that looks like it's confirming everything that I've forecasted so far. Now let's hop to the spiders right now. Again, this is the S&P 500 ETF, and as you can imagine, because the VIX is bearish, I'm saying that the S&P is going to be bullish. Again, look what happened here. We had a role reversal gap fill point right here. That was this horizontal line, and look where we wound up. Look at that. We wound up right at that support level, right? So what I'm going to do is I'm going to erase all these lines, and this is my final analysis on the S&P. I'm going to draw the horizontal line from that low right there. That will most likely hold the support. Let me go through the checklist, right? That's a hammer pattern. That's bullish. We have a gap above the market. That will act as a price magnet. That's bullish. We have a drop in volume on the way down. That's bullish because it's telling us the sellers are slowing down. We're not getting a buy signal on the stochastics, and we're not getting a buy signal on the CCI. However, we are getting a hinge on the CCI, so I'm going with my forecast being higher to fill this gap above the market on the S&P. Again, once we hit that target price, if you're long, I would strongly recommend that you set your stops, trail your stops, move them up, protect profits, and prevent catastrophic losses. This is a market that's charged with emotion, and you want to make sure that you're following the rules. Now, on June 22nd, I'm having an open house Q&A. Again, it's open to the public. If you'd like to attend that, it's on GoToWebinar. It's free. Just go to a Market Guy's website right there, and you'll see right here is June 22nd, and the registration link is right there. Just click on that, and you'll save your seat. Now, remember what I said about videos. There's a video tab right up at the top. Go there, look at our video library where we have what I call market shots. Market shots are very short videos that give you a quick education, and you'll see right here the 1% rule, the most important video on that page, teaches you how to manage risk. We have trading the gap right there, right? I talked about that today. And we have the role reversal right there. That's something you should learn. So we have 3 videos for you. That should take you all about 15 to 20 minutes. Review that, get your lesson, keep your stops in place, and stay in touch with the market guys. I hope to see you on that open house. I'll answer your questions. I'll analyze your stock. It's a lot of fun, action-packed hour for sure. And you enjoy the rest of the weekend. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.